Hi, everyone. Welcome back to Your Money Matters. I am Angela Giroux, publisher of the Bauman Letter. Ted is on vacation today, but thankfully we've got Clint Lee in our corner. Now, a couple quick reminders before we get started. First, I always like to remind you to please join us at the Bauman Letter. We put together a great deal for you. There's more information above. It's completely risk-free. And second reminder is that we do record these ahead of time. And today being Friday, we just recently heard from Fed's Jerome Powell about what they plan to do. And the news seems to be good. Rates barely budged, and he did indicate that they would taper, but it doesn't seem like it's happening anytime soon. And as a result, the markets are cheering. Let's look at a chart real quick. You can see here, everything is really up across the board. Energy is just completely taking off, but you've got growth is up, cyclical is up. Everything is responding very positively to this news. So Clint, what do you make of all of this?
What I make of all of it is that Powell did a very good job of threading the needle and giving something to everyone. Coming into today, I think my expectation was that you would still see some kind of a sector rotation. We've seen sort of this growth versus value theme just playing out all year long. A back and forth between those two areas. But today, when you look at the chart you're just showing, today it's all about beta. The higher beta sectors, no matter growth or value, are all performing well. And so that's one thing that stands out versus what we've seen so far this year. The other thing, probably the most striking thing to me is what you mentioned earlier, is the thing that's not moving, and that's interest rates. I was expecting a lot of volatility, especially in the 10-year Treasury yield coming in today with the setting expectations for future policy. And that's one thing that isn't going anywhere. And I talked about that in the Bauman Daily Friday video. Here's an updated chart of the 10-year Treasury yield that I shared on Friday as well. And we're still stuck in this range that I was highlighting, between that 1.40 on the upside and 1.18 on the downside for the 10-year Treasury yield. I outlined some scenarios of what to expect if we were to break out of this range. We could definitely still break out of this range here in the coming weeks, but I expected more movement out of this today, and we haven't seen it.
Now, if you had to say, he said a few things today, what was the one thing that really sent stocks tearing? And then I have another question, because we do make some predictions here and sometimes it comes back to bite us, but you made some prediction in the Friday's video. And how did his speech match up against what you were predicting?
I'll answer the second question first. So there was one scenario that, I gave a couple scenarios of what to watch for in Powell's speech. And one of those scenarios was if there wasn't an announcement on tapering, or tapering is getting pushed off because they were deferring to some of the challenges with the Delta variant and rising COVID cases. We've seen that impacting some economic data. So one scenario was, and that's pretty much what they acknowledged. He didn't come out with a definitive taper announcement. They acknowledged the threat to the economy from the ongoing pandemic. But that did not, and the other side of that then was that they were not as concerned with inflation. And so the expectation was that those things all combined would have sent rates shooting higher, which once again, as we were just talking about, we didn't see. So the prediction came true, the response from rates did not. But one of the other surprising things about his speech was that he actually spent the bulk of his speech playing down the inflation threat. He talked a lot about why the jump in inflation we've seen recently is transitory, it's temporary. We've talked about it on here before. Ted's talked about it in terms of a lot of this is just being caused by supply chain disruptions, shortages of materials. Those are the things that are driving prices higher. It's been driven by the pandemic, and those things are temporary. Once we get the supply chains and the bottlenecks figured out, those pricing pressures will start to abate. And Powell was echoing the same thing, making a very strong argument for why you shouldn't see this sustained jump in inflation. Now, there was that aspect, but probably the biggest thing I think that stands out to me, and I think the markets are responding favorably to this today. It could actually become kind of an issue down the road, but there's this whole concept of what I'll call decoupling. One of the big concerns coming into the Jackson Hole speech was sort of this tapering timeline, and it was going to be interpreted as a timeline on how the Fed would start to pull back on all the stimulus that it's doing. But they made it very clear that if they start to taper bond purchases, that in no way impacts the timeline for raising interest rates. I mean, those are the two big things right now. There's quantitative easing, and then there's this zero interest rate policy. In no way does QE impact their timeline or bring forward the timeline for what they're going to do on interest rates. I think that's a very important point.
Now, we were talking about this internally this morning. We were saying that this was actually a pretty boring announcement, truth be told. But the stock market disagrees. My personal portfolio disagrees. It's looking very nice today. So now that we've heard this from the Fed, is it sort of a green light that we can just pile back into stocks?
Well, I would argue that the markets do like boring, and that's why they're responding well today. No, I think so. Yes, you can go back into stocks, but you need to be selective about the opportunities you're taking, because it comes back to sort of this whole decoupling thing. What I think is really going on, you've seen more and more Fed officials coming out and voicing their concerns, expressing their concerns about how QE is creating these other imbalances, creating these other asset bubbles. They've talked about imbalances in the housing market and what's going on there. And so I think what they're starting to see is that there's more risks to financial instability by continuing to pursue QE versus more QE helping them get to their goals, especially on the employment side. And this is something we talked about before. Ted's talked about this in terms of how QE helps financial assets. It makes its way into financial assets as opposed to the real economy. And so I think that's behind the scenes sort of a message that's starting to come out from the Fed. And QE, I mean, that's been a major boost to the stock market. And so, while we have this decoupling theme, I think one big risk here, just going into later this year, is the removal of QE. I mean, that's been such a big major support for the markets. And just to illustrate why, here is a chart of the S&P dividend yield in the blue line versus 10-year treasury yields, which is the red line. And this goes all the way back to 1954, but I'm putting this up here because I want to illustrate this point of TINA, TINA. There is no alternative. When you look at the right-hand side of this chart, rates have been driven so low, whether it's on the short end of the yield curve or with the 10-year, that if you want to get returns somewhere in the capital markets, it's forcing a lot of people into stocks. And by taking away QE and the downward pressure that's had on interest rates, that starts to create some risk here for the markets as well. Now, I mentioned earlier that you can be selective. You can look at some opportunities. The high growth, very speculative areas of the market, I think they're breathing a sigh of relief today that there was no official taper announcement. But based on what Powell said, I mean, and he supports doing something by the end of the year. So it's coming. So the one area that you can look at is on more of the value-oriented side of the market. That's trading at a big discount to where growth stocks are at right now. Just a couple charts here to illustrate that point. This first one, this looks at forward PE ratios for growth stocks relative to value stocks. And when this goes all the way back to 1997, this is from JP Morgan, when the line's above zero, that indicates growth is cheap relative to value. When the line's below zero, it means value is cheap relative to growth. And you can see that this line right now is at its lowest point since the 1999-2000 tech bubble. So there's still value to be had in this market in value stocks. One other measure to illustrate this point, because we always talk about how expensive stocks are right now, but a big reason for that is because of how high valuations have been pushed in the growth space. So here's another chart just to illustrate that point. And this looks like the valuation spread between the most expensive stocks in the S&P versus the cheapest stocks in the S&P. It looks at the top and bottom 20th percentile. And this tracks that shaded area tracks that spread through time. You can see how wide that spread is right now. But look at how the upper end of that spread has jumped. That's indicating that it's just been more valuations getting pushed up in those growth stocks that's creating this valuation spread. Meanwhile, there is still opportunity when you look at some of the cheaper areas of the stock market. And so that comes back to something we've been talking about in recent weeks. There's still a couple areas you can look at. One is to look at sort of this GARP principle, growth at a reasonable price. We flag healthcare as being attractive on that measure. Healthcare stocks are relatively cheap right now. They have good earnings growth prospects going into next year. Something like ticker XLV is one place to look at. Another is looking at opportunities now that are cheap relative to their longer term growth potential. And recently we've talked about automation as part of that with bots, ticker BOTZ. And then the other opportunity I would come back to is that going forward, when you look at the total return potential for your portfolio, I think it's going to be a lot harder to come by returns from rising prices. You need to look at the dividend aspect, how much income you're collecting as well. And to that end, we've talked a lot about REITs and closed-end funds here recently. So do not neglect that aspect of your portfolio, especially here going forward.
Absolutely. And I know I said this at the beginning, but I wanted to reiterate, we are recording this on Friday. We often take a beating in the comments when we come out with a video and then the markets are down the next day. And I would say, Clint, there's probably a pretty good chance that there could be some profit taking on Monday. Wouldn't you agree?
Very possibly. I mean, look, I've seen so many times now, especially around the Fed meetings, important Fed announcements, the knee-jerk reaction the day of and the follow through the next day. They can quite often be very different, yes.
Right. And also you gave a great reminder about dividends, endless income, as we call it over here on Bauman land. And that is one of Ted's model portfolios that's absolutely crushing the market right now. So again, make sure you join. Clint, thank you so much. And I'll speak with you next week.
Thank
Have
you.
a good one.